Good morning, and thanks so much for tuning in. This is Stocks to Watch on BloombergQuint, and I'm Mathew. Once again, today it's an interesting trade setup. We've got momentum on our side here in India, but the cues from overseas are not so great. We've also got the IT pack that is going to be in focus yet again today on account of the Infosys results. We're talking about that and a lot more on today's program. My guest today is Dharmesh Kant. Thanks so much for joining me today, Dharmesh. And I want to start
Good
with
morning.
good morning. So I want to start with Infosys because that's clearly going to be the stock to watch at the start today. It underperformed yesterday, but perhaps that's also on account of the stellar week that it's had, 6.5% gains all told for the last week, despite the fact that it corrected nearly 2% yesterday. But the numbers were quite good, I thought. They were much better than expected. Dollar revenue up 6%. You had revenue up about 4%. You had constant currency growth for the quarter at 4%. You had margins that beat estimates at 25.3%. Estimated was 22.2%. And you had net profit gaining as much as 14% to 4,858. Essentially, again, better than expected. Uh, what would you have to say with regard to the numbers, and also the fact that they have in fact changed their guidance? They've increased their guidance both on the revenue side as well as the margin side. How much of this is on account of employee costs and the other costs that have been under control in the second quarter?
Good morning, Alex. The numbers were stellar on all the counts. I mean, very impressive as far as reported numbers are concerned on optical basis. But the underlying fact has been the top line was good because, if you look at the financials, BFSI segment has done very well. And US, all the companies, I mean, financial companies have put a very good set of numbers, be it Citibank or BlackRock and the others in the same league, have been reporting good volumes. And Infosys and the likes of the same have been catering to these companies in a big way. So that was one of the prime reason why you have seen a big improvement in the top line, and that is creditable for a company like Infosys because it has been fighting its end to grab the business share of the market share from TCS and Cognizant. As far as operating profits and the improvement in margin is concerned, it is more on account of no increase in employee costs because there has been no appraisal this year, and Infosys has said that they will be doing so in the month of January. So one more quarter to go as far as employee cost is concerned. Marketing distribution expenses has not been there, and traveling expenses was not there. So and as far as guidance is concerned, I don't give much credence to Infosys guidance of late because quarter on quarter we have seen great variation in that, and maybe from Q4 onwards this 24-25% kind of an operating margin can again be trimmed down by 100 or 150 basis point after all the hikes which are in place, and currency will also play a part as far as reported earnings are concerned. Having said that, if you consider in the current market scenario, IT still remains a top pick and as a sector, and Infosys and TCS have been doing fairly well out there. I think most of the positive is already in the price. I may not expect a good run up in Infosys today, but any correction if the market offers, just because of market sentiments running for profit taking for some time, one should be adding on to Infosys and TCS, and maybe 15-20% is there on the cards to be made for next 1 year time frame. So that's a decent return considering the high margin of safety which these companies offer, and the risk reward ratio is totally in favor, and there's a scarcity premium because there's hardly any sectors which are doing well and coming out
Hmm.
with positive growth. IT
Yes.
will continue to rule the roost.
Yeah, and that's showcased in the fact that the stock has gained about 55% for the year so far. I want to talk, Dharmesh, next about Tata Elxsi. It's come out with its numbers as well, and its revenue is up 7.4%. Once again, the net profit has come in at 14.5% at nearly about 80 crore. But once again, the margins have come in better than expected at 27.5%. And I think the company attributes that to lower expenses on the employee side and revenue growth added, which has basically improved the margin performance. But how would you rate the numbers, and would you say that Tata Elxsi, being a slightly different play in the technology space, is a good buy at this stage?
See, again, expensive as far as valuation is concerned, around 27, 28 kind of a P multiple is trading at 1 year forward. And but it's a different company altogether. It should not be taken in the same light as a Infosys, TCL, or HCL Tech, because it's a company which helps in developing products and electronics for different companies in the automobile segment, communication segment, and media and broadcast. So it's a enabler kind of a company for other companies for their products and services and getting the best of out of it, be it IoT or cloud computing, or maybe artificial intelligence and augmented reality. And so forth and so on. The company is in a different league, and this order book has been very lumpy. If you look at last 3 4 years, it has been a lumpy kind of an order book, and quarterly earnings also has seen quite a variation. But a small size company, I mean 1600, 1700 crores kind of a top line it gives for an annum, that was for FY20, a bit 250 to 260 crores of a bottom line. And at 30 P multiple, I think again valuation a bit stretched, so one should wait for a correction. But one can add to it because it will enjoy a scarcity premium in the segment in which it operates, because virtual reality and things like that. Very few companies are there in the listed space in India, so there Tata
Hmm.
Elxsi gains a point. So I'd be advising investors to add on corrections, and again 15-20% kind of a top line gain. I mean, stock price gain can be expected in a year's time.
Okay, now moving from a sector that has actually outperformed in terms of at least the stock prices and now recently the quarterly performances, we're going to a sector that has grossly underperformed, and that's primarily on account of the fact that we've had lockdown situations and nobody's been flying. I'm talking about airlines. So we've got a couple, Interglobe Aviation and SpiceJet. We had the update yesterday on the load factors for the industry, and they've come in for September at 60.5% versus 63.2%. But I think that has to do with the fact that we had more flights operating, Dharmesh. I think you had an average of 2,673 flight movements as on September 29 compared with just to over 2,050 at the end of August. And more passengers flew as well, the highest passengers in 3 months. So that sector seems to be slowly crawling back to normalcy, but it's still a while to go, I would think. Would you pick up either Interglobe or SpiceJet at this point?
See, Alex, just as a trading play and given the momentum, the way this market has been functioning off late, because anything which is getting back to normalcy is being rewarded. So it's just that factor. So still, I think in the aviation sector, even SpiceJet may rally, but I would prefer Indigo over SpiceJet just for this trading play. But if you go back a year back, I mean, even if you go by the end of FY20, when everything was normal, and this sector for the last 10 years has done nothing as far as return on capital employed is concerned. And the differentiating factor in this sector was always Indigo, and they have been doing pretty well till they
Mm.
did not raise debt in their books. So it was all about, return on equity. Whatever they were managing was just because there was no debt in the books. Otherwise, if you look at the, oil prices, any, Brent, if it is trading above 65 to $70 kind of a thing, NYMEX primarily, then these companies start reporting operating losses. So
Mm.
their, breathing space is below $65. And even if you look at last year's number for Indigo, it was quarter, June quarter and December quarter where they have been able to do well because of the crude prices not being high and currency was stable. So given the fact that it's still around $40, $42 kind of price and currency has not depreciated that much,
Right.
I mean, a trading play can always be there, but as an investment bet, aviation has never, if there is no return on capital employed, why should you invest in a
Right.
sector?
Fair enough. Fair call there. So fundamentally, avoid at this point. Thanks so much, Dharmesh, for joining me on this
Thank you so much.
conversation as always, and thanks for sharing your views. To the viewers, do stay tuned. There's a lot to talk about in just a short while, and you'll find all of it on BloombergQuint.